speakers this evening, which I'm sure you'll find they're on the right wavelength with most of you. Douglas Carswell, who's delayed at the House of Commons, but will be joining us shortly, and Professor Tim Congdon. Tim is an old friend of the Bruges Group and has contributed many publications over the years that have been very well received. His latest one, which some of you have probably read, was The City of London Under Threat, the EU and its attack on Britain's most successful industry. Tim is the founder and chief executive of International Monetary Research. This is a venture that Tim has started in the last year to 18 months, and it really provides an authoritative analysis of trends in money and banking, both here in the European monetary zone and the United States. And it should be compulsory reading material for all central bankers. As you know, in the late 80s, Tim also founded Lombard Street Research, and from 1992 to 97, he was one of the Chancellors of the Exchequer's group of wise men. Now, there are many subjects Tim could have spoken on tonight, on which he is authoritative and also very topical. He could have talked about financial regulation. He could have talked about monetary developments in the United States and banking supervision here and in America. There's a whole host of subjects, as you know, Tim is a great expert on, which are very relevant to the way the world economy is developing at the moment. But tonight, his subject is the crisis in the Eurozone and whether it is going to break up. Tim, we look forward to your comments. Thank you.
Well, good evening, everyone. It's nice to see such a good turnout on a rather sticky summer's evening. I'm going to be talking about a very topical issue of the Eurozone and the crisis in the Eurozone. Can I just make sure, can everyone hear me all right? Is that okay? Good. And I'm also going to be, I apologize for this, I'm going to be telling everyone, I told you so. I found that the older one is, the less people remember what one said. You know, you think that what you said in your 30s and your 40s was such pearls of wisdom, they remember it 20 years later, they don't. So I'm going to recall some things that I said in a paper in 1998. But in fact, the central topic that is really this question: can a monetary union, where you have several countries, several governments sharing one currency, can that work without movement towards, I hate this phrase, progress towards, movement towards political union, meaning one government, one parliament, one set of laws, and so on. This was always the core question with this experiment. Europhiles called it the European construction. This was always the key issue. Many Eurosceptics said that it couldn't work without political union. So did many enthusiasts for the project, including such people as President Mitterrand and Chancellor Kohl. And they saw monetary union as something that would act to bring in political union over time. I'm going to argue that, but there were some other people actually who said this can go on forever without proper political union, and they were quite a long time now, they're prepared to be right. What I think there was never any question about was that with full political union, monetary union was feasible. And I want to just say this for a couple of reasons. One was that in the 1990s, there was an obvious example of this. There'd just been German monetary union and political union. In fact, the monetary union, I think, was just before the political union. And at any rate, they basically went together. Although it was a rather messy process, it's clearly there for good, and no one doubts that it can work. But there was full centralization of taxing, full centralization. Many taxes in Germany apply to all of the Länder and the whole of the country, and there's also full centralization of much of government spending. So there was never any question about that. And the second thing I want to say is that I did, and mea culpa, I did say we're really right up to 1997, I didn't think this thing was going to happen. Because I thought, frankly, that they were like builders. And they kind of have a vision, have a facade. Lovely columns and lovely, it looks beautiful and everything else. But they hadn't sorted out the plumbing. And, after a bit of time, it'll start to smell. And when it's no good. And anyhow, it's been there now for over a decade. Effectively, it started in January the 1st, 1999. And, there was this facade, and much of the time it appeared to be working, and it wasn't smelling either. The plumbing appeared to be not a problem. Well, let me assure you, ladies and gentlemen, the plumbing isn't working, there is a smell, and in terms of the question of this thing is about to break up, and if I'm asked for a timetable, I will say the next 3 to 6 months, and I'm going to try and justify that conclusion in the next few minutes. Before I do that, let me just sort of be a little bit self-indulgent and go through some things that I said and what some aspects of the whole process. When you've got a government, single country, single government, usual monetary jurisdiction, the government can borrow from the central bank, create new money, and if this is on excessive scale, you get inflation. When you've got a standard monetary jurisdiction, one government, one central bank, one money, one legal system, etc., it's very clear what the cause of the problem is. It's government borrowing from the central bank. That government is to blame. That central bank is to blame. It's clear what's going on. Got a monetary union. At the moment you've got 16 governments. If the Greek government, little government, borrows too much from the central bank, is that government to blame for excessive inflation? Well, I don't think so. It's too small. So all governments have got an incentive, as far as they can, to borrow from the central bank to be, in that sense, financially responsible, and you've got what's called a free rider problem. Now, that problem can be anticipated, and it was anticipated by a treaty agreement on the size of budget deficits and also a prohibition on government borrowing from the central bank, as in the 1992 Maastricht Treaty. But for a number of reasons, this treaty was never really credible. And just to sort of, I wasn't the only person to make these points, but if governments had an excessive deficit, a deficit that breached what was called the Stability and Growth Pact, also known as the Stagnation and Growth Pact, if they had an excessive deficit, then they would be obliged to lodge some money with which they've received no interest, and there'd be a fine imposed. Of course, the fine would increase the budget deficit because it had to be paid by the government that was responsible for it. In the extreme, suppose the government took no effective actions. Would the union expel these delinquent nations from the monetary union? Perhaps that was always the threat, but the treaty said nothing about the mechanics of expulsion. Then what happens if a number of European countries with excessive deficits, they've all got excessive deficits, you have a blocking majority on ECOFIN, or also, by the way, in the Governing Council of the ECB, so delinquents can put together a vote to outvote, well, Germany in practice. In the extreme, the high deficit countries might outnumber the low deficit countries, so the financial delinquents control ECOFIN, or the Governing Council of the ECB. In that event, the incentive for every European government is straightforward: cheat on the public finances, maximize the deficit, and to hell with the inflation rate. The answer: there has to be a single federal government, there has to be a centralized treasury, and so on, and then monetary union has led to political union. Please, central bankers are very powerful people. They need to be kept in check. So, by the way, are commercial bankers. They're also very powerful people, and banking is a very political industry. And so there has to be some accountability to the legislature, maybe the executive, maybe some combination of the two. But in the Eurozone, you've got these 16 governments, you've got this treaty, you've got this rather weird structure of the European Central Bank and the Euro system with actually 16 central bank members. And it's very clear that the ECB is not accountable to any national government. It's true enough that Trichet is prepared. He refused invitation to talk to the French Parliament. It's true enough that he does give evidence to the European Parliament, but that then raises a whole mass of questions about the status of the European Parliament relative to national parliaments, and also, of course, to national governments, and so on. So, again, when you get a big crisis, what is likely to happen is that the Maastricht Treaty would have to be revised. There'd be new powers to the European Parliament to discipline the European Central Bank, the for monetary policy, etc., etc. And by the way, that's more or less what's happened. That is in the Lisbon Treaty. That has the same conclusion. There have been more powers to the European Parliament, and it's clearly intended by some people that the European Parliament is a kind of proto-parliament for the entire Union. It is to be, in other words, monetary union has again led to political union. Another argument. When I can find one of these things, the cost of printing these things is a fraction of the £20 that it's worth. And the difference between the two is called seigniorage. Now, central banks also make profits. I may surprise you if they do, actually. At the moment, banking is hugely profitable, but they make profits. Who owns these profits? Who owns the seigniorage? Who owns these central bank profits? Well, in Britain, there is a single government, there is a single parliament, there is a single set of laws governing this particular subject, and there is a single central bank. So there is no two ways about it. Ultimately, the Bank of England makes a huge amount of profit. That actually benefits the British government, British taxpayer. Again, we have over there is Eurozone, 16 governments, 16 central banks. There is also seigniorage. There's also central bank profits and losses. Sometimes these profits and losses arise because of business in Greece, or in France, or in Italy. But actually, how much of it is in Greece and France and Italy? How do we distribute this between the different nations? So again, you get this pressure for some federalization, some pooling, some political union to follow monetary union.